the days of that suppression have probably come to an end. And I would expect, therefore, to see the silver price be freed, if you like, from this sort of suppressive intervention by China. I don't think they're doing it anymore. It could well mean that as gold continues to go higher, in other words, currency values continue to decline, on that basis I would expect silver's got quite a lot of catching up to do.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 24th through March 3rd, 2025, while supplies last. Our choice 1-ounce backdated silver Royal Canadian Mint Wild Life Series coins are just $2.99 over spot per ounce. Pre-1965 mixed junk silver is just $1.99 over spot per ounce. And pre-65 half dollars are just $2.25 over spot per ounce. Backdated 1-ounce gold South African Krugerrand are just $49 over spot per ounce. And 10-ounce silver Nordic Mint bars are just $2.10 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always glad to have this distinguished returning guest. Alasdair Macleod is a former bank director, a former head of research at a major gold company, and also he's head of his own Substack now at Macleod Finance. Alasdair, thank you for joining us here again this Thursday, February 27th, 2025 on Liberty and Finance.
That's my pleasure.
You've written recently 2 articles that got my attention because I thought they would be of high interest to our subscribers and viewers. One is titled How Silver Has Been Suppressed, and you're getting into specifically starting out with stories of how China has been covertly amassing more silver than the official channels of off-taking from the exchanges, for example. And also, you have a story, an article on Batten Down the Hatches, foreseeing storm clouds brewing right now on the economic and monetary front that's affecting the markets. Can we start with your examination of silver price suppression? It's something that's very long-term, of great concern to our viewers and subscribers, especially those who are convinced that silver is one of the most underappreciated assets in the world, and that if you look at the price compared to its previous nominal highs, even that were set back in 1980 and 2011, it's less than 2/3 of those at the moment. But if you do it inflation adjusted, it's way down in what you could call value territory, putting it optimistically. So your view of this, the reasons for this surprisingly low price of silver over a period of time, and how that has been maintained.
Well, it's a fascinating story. Here as you rightly point out, the silver price is extremely low. The gold to silver ratio, or is it the silver to gold ratio, is over 90. This is really crazy. I mean, the good news in this is that if you go back to the regulations of 1983, which appointed the People's Bank of China with full responsibility for managing China's gold and silver acquisition program, dealings, whatever you like to call it, then we've concentrated on gold, but we forget that this also covered silver. And we also forget that as recently as 1935, China was on a silver standard, not a gold standard. Banks held silver as, in reserve against what their customers might sort of decide to encash banknotes for. Individuals stored silver. So, that's only 90 years ago. That's sort of just in living memory for some of the really older Chinese. Now, I think it's clear to me that China used the enormous bear market in gold between 1983 and 2002 to acquire a basic holding in gold. And I did some sums in terms of exchange flows, capital flows in, export flows out, and so on and so forth, and came to the conclusion that at contemporary prices, the PBOC could easily have acquired as much as 20,000 tons. It was at that point that the PBOC set up the Shanghai Gold Exchange, which is controlled by the PBOC, incidentally, so it's within the mandate of that original legislation in 1983, and allowed Chinese citizens for themselves to acquire gold. Now, when it comes to silver, it's a different situation. You didn't have a clearly a clear bear market, if you like, in the way we had in gold. Silver even then was behaving somewhat differently from gold as a monetary metal. But there is no doubt in my mind that there was a second program at the People's Bank of China to acquire silver reserves, if you like, which would be, like the gold reserves spread around the People's Liberation Army, the Communist Youth Wing Party, and so on and so forth. I mean, there are various government accounts where all this stuff was concealed. Now, I had a speaking engagement in New York back in, I think it was about 12 years ago, something like that. And I thought I'd have a look at this and try and work out where all the silver was going and what was actually happening. And at this conference, there were a number of silver producers and exploration companies with stalls. And I asked the management on all these stalls, how did they turn their silver into cash? Because, if you're managing a mine, you're not necessarily interested in what's coming out. You're interested in what it sells for, because you've got to pay wages and you've got to pay fuel bills and all the rest of it. And the same story came from all of them. The man would come along from, rather like the man from Del Monte, the man from either Trafigura or Glencore would come along and assess the value of the doré. And on the basis of his assessment, two things would then happen. The doré would be shipped off to nobody knew where, and also the mining company got paid for it. So you've got three parties in this. You got the assessor, you got a bank, and you've also got the refiner. Now, in those days, and I think it's probably still generally true now, because refining silver, smelting it, refining and all the rest of it is a pretty, I suppose, environmentally unfriendly business. And it's quite energy intensive and so on and so forth. The Chinese were by far the cheapest and most ready refiners of silver. So all this doré was getting shipped over to China in order to be refined. So not only that, but China was something like the fifth largest mining nation for silver itself. So you can see that by taking on this role, it could quite easily accumulate all the silver that it would need to satisfy the monetary purposes which were intended in the original 1983 legislation. And I believe that's basically what has happened. So China has now got significant undeclared stocks of silver, and it will be, in terms of tonnage, considerably more than what they got in gold, obviously. The parties involved with this were Glencore, mainly. The bank would have been JP Morgan, I guess. And the other thing, of course, is that as the silver doré was taken on board, then that needed to be hedged in the futures market. And this is why you had JP Morgan appearing in the market, selling futures the whole time. And as far as the silver bulls were concerned, thereby deliberately suppressing the price. But it wasn't deliberate suppression at all in that sense. It was just part of the whole thing. I think it was intended to hit the price because as far as China was concerned, they wanted to acquire their silver without driving the price up. So I have little doubt that the management of the price was part of this whole process. So are they still doing it? Well, I don't see any reason why they should be still doing it. There may be an argument that they would want to keep the price suppressed because they're a major manufacturer as a nation and exporter of photovoltaic cells and other electronic goods which rely on silver. But that edge is going a little bit. I mean, India's sort of muscling in on the act and all the rest of it. And I think that just controlling the silver price purely for that purpose doesn't actually make an awful lot of sense. So my feeling is that the days of that suppression have probably come to an end. And I would expect, therefore, to see the silver price be freed, if you like, from this sort of suppressive intervention by China. I don't think they're doing it anymore, which is interesting because it could well mean that as gold continues to go higher, in other words, currency values continue to decline. On that basis, I would expect silver's got quite a lot of catching up to do.
In addition to your article about silver price suppression, you also penned one called Batten Down the Hatches, and you're tying some major events that are happening in Washington with perhaps a stumbling and signs of topping in the equities markets. You've written in the past that we'll see a rotation out of equities into bonds and then bonds into gold. Can you give us your view of what's going on? What are the drivers that are affecting the choppiness in the equity markets and where you see that leading next?
Yeah, sure. Basically, I think the first point to understand is that we go through a cycle of credit bubbles. And what happens if government doesn't interfere is that, at the end of the cycle of credit bubbles, then, suddenly things come to a halt. You get a slump in business activity because credit is no longer being extended. And you'll find that businesses go bust. Banks get very, very cautious. Some of the banks may indeed get into trouble themselves. And once that all sorts itself out, if you like, it's Schumpeter's creative destruction. Once that sorts itself out, then we're off onto the next growth phase. Now, these bubbles, certainly since the 1980s, have never been allowed to wash out all the malinvestments on that cyclical basis. The result is that there has been a sort of continual build-up of bad stuff, if you like, within the credit bubble. So much so that this is now the largest credit bubble we've ever seen. People aren't generally aware they're in a credit bubble. But if you look at the other side of it, which is debt, my goodness, we're all aware we're in a debt bubble, but debt equals credit. I mean, it's the other side of the balance sheet. It's as simple as that. So this is a huge, huge credit bubble. It's the largest we have ever seen in history, which has been allowed to accumulate courtesy of fiat currencies. So when that breaks, then it's going to become a really important event. The first sign of this, I think, is when you see the bond yields having risen, and when you see the equity market stalling, you know that credit is no longer feeding into the market. So that's the first sign of it, really. And I think we're beginning to see that. If you look at how the major indices, and particularly the tech-heavy indices, are performing, you can see they're running out of steam. If you look at the margin debt, and by margin debt, I mean the debt which is taken out specifically to leverage people's investment positions, that is now at an all-time high in America. And these are NASDAQ figures. And the other indicator is really the most speculative indicator of the lot, and that's Bitcoin. Bitcoin topped at something like 108,000, and it's now 88,000, having yesterday gone down to 86,000. That bubble is bursting, and there's going to be a lot of tears, I think, in the crypto market. So when that bursts, then, as I say, it is going to be, if you like, a wealth-threatening event. It's going to wipe out a lot of wealth, but it will also cause portfolio shifts, and we are seeing that happen. We've seen that bond yields have declined, and this would be, I believe, new money or new credit being angled not at equities, but being angled at bonds to try and reweight portfolios. I think the rise in the price of gold, which, as I always insist, is actually a reflection of the falling purchasing power, the falling value of credit, that is also, I think, quite a clear signal that things are not going at all well. And then we look at the basic economy. I think the consequences of Doge and all the rest of it. I mean, Doge this week turned around and said to everybody, all government employees, you've got to justify your existence. Please have your justifications in this office by the end of the week, and also copied to your senior line manager. Now this is threatening the existence of contracts into the private sector. The private sector was already suffering. If you take out the budget deficit out of GDP, you can see the private sector is contracting. I mean, it's as simple as that. And I calculate that after, the official rate of inflation, according to the Congressional Budget Office, adjusting the figures, you can see that actually the contraction in this current year on the CBO's own figures, of the contraction of the private sector is likely to be over 5%. 5.19% is my calculation. And those are on, conservative government figures. Now, I think that the threat to government contracts and all the rest of it going to the private sector is just going to make this situation far worse. And there is, I think, growing fears that not only is the economy stalling, but it is going to go into a slump. Now, if that happens, then this budget deficit is going to soar, simply because revenue is going to decline. And while revenue declines, you'll also find that welfare payments and all the rest of it increase. Government finances are going to be in a huge, great mess. And then put on top of that Trump's tariff policies, that beautiful word, tariffs. And you've got an absolute classic doppelganger for the 1929 to 1932 period, when you had the combination of a bubble bursting, the bubble which was engineered by the Fed, incidentally, under Benjamin Strong in the late 20s. And at the same time, you had the Smoot-Hawley Tariff Act, which was passed in 1929 and then enacted into legislation by President Hoover in 1930. We've got exactly the same thing today. And look what happened in the 1930s. Something like 5,000, 6,000, 7,000 banks went bust, which is why actually, the credit actually contracted, because it just got wiped out. So, with the prospects of that, with a few extra things like, we've got supply chains around the world now, which we didn't have in the 1930s. Breaking those, I mean, they're already being fractured, but breaking those, I think, is an extra dimension to the whole problem. The rest of the world is going to go into a slump as well. The tariffs against Canada and Mexico are reaffirmed this week, and it looks like the EU is also going to be hit with 25% tariffs. This is Smoot-Hawley Mark II. This is the Wall Street crash, Mark II. We're talking about a combination of these economic events, which are completely unavoidable, coupled with the collapse of credit. Or if you like, you probably understand this more by calling it the collapse of the value of the debt, because the debt is the other side of credit. That's really what the credit bubble is. It's the other side of debt. So this is going to be a big reconciliation. And anyone who is in credit, I think, is going to, which we all are. I mean, we use credit. We don't use money. We don't do transactions with gold. It's all credit. That is going to be a major, major problem. And I think that the Fed's mandate under these circumstances is quite clear. Don't defend the currency. Try and defend the banks. Stop the banks going under. Stop the whole of the derivative system. We're talking about hundreds of trillions of dollars worth of obligations, which again are debt on one side, credit on the other. Stop them collapsing. You don't want counterparties in those chains going wrong. The whole thing is actually looking extremely dangerous. And that was the whole point of my article, to draw attention to the severity of the situation.
Now, you said the most serious part of this, two parts you touched on. One, you said that we're all using credit. I believe that most people have no idea that that's the case. Most people, I believe, are under the impression that their printed balances in their bank deposit slips for savings, checking, certificates of deposit, money market accounts, etc., and any cash that they have on hand in terms of paper cash and modern coinage and so on, is money. And they don't realize that, first of all, none of that is money. And second of all, anything that's on their bank deposit slip doesn't really legally belong to them as their legal property. It's an unsecured loan to the bank. That this would very much be like a rerun of 1929, when people had no idea that their deposits in the bank. Well, I think maybe people had a little more appreciation then. Certainly my parents' generation and their parents who lived through the Great Depression understood runs on banks, and concept has almost faded. People are numbed down to think, well, don't worry, the FDIC insurance has got us covered. It doesn't matter. The banks can't get in trouble. Now, when you talk about the feds, who are the bankers' bank, get push comes to shove, they will not defend the currency and defend the people. They will defend the banks to whom they owe their true allegiance. Can you talk about what that looks like and how this plays out? And then I'll have some more questions for you after that. But first of all, what does the Fed defending the banks rather than the dollar look like from the cheap seats of the ordinary person?
Yeah. Well, we saw, if you like, a dummy run of this back in 2007, 8, 9, when we had, the Lehman crisis. And we saw from the Lehman crisis that if you don't rescue a bank like Lehman Brothers, then, there will be a moment when you think the whole system's going to fall apart. But basically what the Fed did was they just wrote an open check. They said, we will throw whatever is required at this problem. We will make all liquidity that the private sector needs available. And so they rescued the banks, and they rescued the insurance companies, AIG, which was one of the principal producers of derivatives at that time. So the whole thing was really, if you like, a rehearsal for what's going to happen this time around. Now, you may remember that the initial crisis meant that gold went down. It went down from, I think it got up to close to $1,000. It went down to something like 680. And then subsequently, when the implications of this were more properly understood, it then went on and rose up to about $1,920 by, I think it was September 2011. So, things don't necessarily happen in phase, but the one thing was absolutely clear is that the dilution of the purchasing power of the dollar and the loss of faith in the purchasing power of fiat currencies generally came out of that rescue attempt, the successful rescue attempt by the Fed of the US banking system. Of course, the problem rumbled on in Europe. I mean, we had the Cyprus problem, we had the Greek problem, we had Portugal, and so on and so forth. The German banks, a lot of the German banks got into great difficulties. But that again was directly because they were involved in investing in the US residential property market. So that I think is probably, the carbon copy of the approach that the Fed will apply next time round. But it's not going to work. I really don't see it's going to work. I mean, the other problem is that as they dilute the purchasing power of the dollar by increasing its quantity, and as foreigners look at this, I mean, remember, foreigners own something like $15 trillion worth of US equities. I mean, are they going to hang around while this happens? I don't think so. I think they're going to get out. Now, whether they get out of the dollar as well, of course, is a separate matter. But you can see that the whole situation is likely to undermine the currency. Currency being the highest form of credit, if you like, which should be attached in its value to gold. Then it would be guaranteed, and there would be some latitude, probably, in the way in which the authorities would handle such a crisis. But without any attachment to gold, which is real legal money, the value of credit, I think, will just take it on the chin. And it's, every form of credit, too.
For ordinary people, that's almost unthinkable in terms of the pain that can cause to have your earnings, your savings, your retirement decimated by debasement of suddenly. We've seen it happening at an accelerating pace over time, but this is a sudden cataclysmic type of a collapse. It also can be just terribly disruptive, as you've pointed out, to contracts or other business operations and things like that that are part of just a functioning economy. When you have sudden changes and decreases in value of the currency, it can completely throw off the rails a lot of the projects, programs, construction, all kinds of things, operation of factories and production, et cetera, that were keeping the economy running and keeping employment going, et cetera, like that. Any particular areas you think we're particularly vulnerable now that may be similar or different to where we were either in 1929 or in the global financial crisis of 2008, et cetera?
Well, it probably happens in phases. I mean, the first phase would be the obvious effect on the banking system, I think. And I would expect the Fed to step into the breach and try and stabilize things. And don't get them wrong. They're pretty good at stabilizing things if they really have to. So let's assume that works. I think there might be a brief period of stability. I'm looking at the economic effect in this stage. I'm not looking at the relationship with gold at all. But then I think there will come a point where this stability gets eroded, and you will find that there is a second phase, if you like, of collapsing credit values. They will certainly be obvious when it comes to credit values, say in stocks in particular, and other forms, if you like, of wealth. Wealth kept in credit. So I think that it will be the second phase, and I think it will be then in particular that you will see the value of the highest form of credit, which in our world is the dollar, really disintegrating. And it will be noticed in two ways. I think firstly, the prices of goods in particular, commodities, will be rising for reasons which we don't really understand, if you like. Let's put it that way. And I think you will also see the price of gold rise, which, as we've discussed before, really reflects the falling value of credit rather than a change in the value of gold. So I think that's how it would manifest itself. And I think it probably could happen quite quickly when it happens. Because really what you've got to, get to is from the point where nobody understands, just as you've described, nobody understands just how ubiquitous credit is. And banks are only a small part of this, incidentally. Credit in the family. Let's say you employ someone to decorate the outside of your house. They do that job, and then they send you an invoice for payment. In other words, what they're doing is they're giving you credit for their labor, which you then discharge using your bank's credit, or using your credit at the bank, rather. So, it's sort of credit the whole time. When you send children to school, you're going to fund their education. And that, again, you are giving credit to your children. Your children actually, luckily, don't seem to have a direct obligation to repay that credit. But nonetheless, this is credit. Everything in the economy is credit. The whole thing. And it's not just bank balances, bank transfers, checks. Everything is credit. And even coins are now credit because they are not gold or silver or even copper in the small denominations. They're just tokens. That's all they are. Everything is credit. And when the highest level of credit, which is the fiat currency itself, where there is no counterparty risk, if you like, because you're getting it direct from the issuer, when that starts losing value, then all the other forms of credit will just fall a lot more rapidly. And the other thing about it, of course, is that when you're faced with that, then the natural level of interest rates or bond yields will rise and rise and rise. And, the idea that, the government can continue to borrow at, 4.5%, 5%, forget it. I mean, that could rapidly become 10, 15, 20%, or even more, depending on how fast the value of the currency declines.
Alasdair, for people who want to protect their families from completely being wiped out, their financial futures, I mean, that's what our channel was founded on, was the basis of prepare to survive and thrive, and ahead of time, not waiting for everyone else to recognize the need, but to do it prudently in advance. What steps do you see as being the most reasonable and time-proven types of preparations to reduce the damage to a household's finances that people, and frankly, for those who are in the responsible role of shepherding funds for homeowners associations, churches, fraternal associations, insurance companies, etc. There's a lot of people, whether you're at a small scale of the individual household or at a larger scale, who need to make decisions that are prudent at any point in time. What do you see as decisions that, if made now, could still reduce the damage to finances for those people who are shepherding them?
Well, I mean, on the sort of practical level, there are things you can probably do. So all this sort of prepper stuff about, own a bit of farmland and all the rest of it. That's not practical for most people, really. The number of times you buy food to sort of store against this event, and you find that it goes beyond its eat by date by months and months and months. You've got to chuck it out and start again. It's actually quite difficult in that sense. I think we have to accept that the consequence of this will be to impact on your, on your cost of living, on the way you live, very, very severely. You won't be able to afford to do things which at the moment you can afford. What I would concentrate on is just trying to protect your wealth as opposed to, your day-to-day spending. And the only way to do that is really to get out of credit and get into gold and possibly silver. As an investor, you could look at gold mines, silver mines, the mining industry as a whole. Because one thing I think which I do have some confidence about is that while we're in pretty much terminal decline, I think that Russia, China, Shanghai Cooperation Organization and BRICS, all of which so far accompanies something like 70% of the world population, is actually industrializing very, very rapidly. So there will be demand for raw materials and commodities and so on and so forth. So I think the mining industry, the global mining industry, I don't think concentrating, let's say, in any one nation, I think we'll probably come out of this as worthwhile investments, if you like. So I think that's that is a route in which you can protect your wealth. There are dangers there because you're still dealing with credit, and what you would be hoping for is that the value of that credit would at least, if you like, make up for the loss of purchasing power of the highest level of credit, which of course is the currencies. So I think that's where I would go. I mean, it is extremely difficult to turn around to people who are accustomed to investing and say, in effect, put all your eggs in one basket. This goes against the psyche of an investor. But I would say that what you're doing is you're not acting as an investor. You are basically trying, the point about investment is to try and enhance your wealth. You've got to change it from enhancing your wealth to protecting your wealth. And that's a very, very different strategy.
For people who want to stay plugged in and follow your prolific writing on a daily and weekly basis, where should they get connected? You're now completely independent at Macleod Finance and on Substack. Where should they go exactly?
Well, it's my Substack is alasdairmacleod.substack.com. If you Google that, or if you Google Macleod Finance, it'll probably take you there. And it's really, I concentrate on trying to educate people about what is actually going on. And the first thing they must do is understand the difference between money and credit, understand the economics that affect that, and also the geopolitics. I mean, as the last comment I threw in, if you like, which I think is our hope for the future, is that there is a new world out there which will take up the baton of progress, economic progress, global economic progress, just as we're discarding it. So that's basically what I do.
And folks, if you don't want to miss a single episode with Alasdair, and we all follow him closely, I do believe, and learn a lot from him, thank you, Alasdair, make sure that you're subscribed to our free mailing list. It's completely private and it's completely free. You just go to libertyandfinance.com. That's Liberty and Finance, all spelled out, all one word, libertyandfinance.com. Put in your email address, click submit. Make sure you confirm on the confirming email, and you'll get one email in your inbox per day with our latest interviews and any gold or silver specials that we are able to make available through Miles Franklin. Alasdair, on behalf of all of our viewers and subscribers who, like me, learn from every episode that we have, every time we have together with you, thank you for joining us again on Liberty and Finance.
That's my pleasure, DK. Thank you for having me.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 24th through March 3rd, 2025, while supplies last. Our choice 1-ounce backdated silver Royal Canadian Mint Wild Life Series coins are just $2.99 over spot per ounce. Pre-1965 mixed junk silver is just $1.99 over spot per ounce. And pre-65 half dollars are just $2.25 over spot per ounce. Backdated 1-ounce gold South African Krugerrand are just $49 over spot per ounce. And 10-ounce silver Nordic Mint bars are just $2.10 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.